Today we're taking a look at Devon Energy. Not an integrated oil giant, no downstream, no marketing hype, just a classic US shale producer. And today we'll examine how strong is the cash flow really, how secure is the dividend, and what does the Coterra merger bring? And is Devon a bargain at $43 or is it already fully priced in? And as always, we'll be looking at all of this today without any marketing. Glasses on, just numbers and just cash flow. Devon Energy is one of the major independent US upstream producers. Their main areas are the Delaware Basin, Anadarko Basin, Williston Basin, and Multi-Basin, but with a clear focus on high-return assets. The current data. Currently, we have a share price of $43, a market capitalization of $27 billion, an EV/EBITDA of 4.4, and a free cash flow yield of 10.4%. The dividend yield is currently at 2.2%. This is classic sale value pricing. Let's also take a look here at how I am invested. In total, I had 6 shares. My entry price was €31.29, currently up by 20%, and I have already received a nice dividend of €4. The 52-week high and low are between $25 and $44. In this case, Investing Pro has once again already generated a report for us. If you also want to use Investing Pro for your fundamental analysis, you can get a 15% discount via the link below. Discount. Now let's move on to production and operational quality. For 2026, the plan is 845,000 barrels of oil equivalent per day and a capex of $3.5 to $3.7 billion. Importantly, Devon can finance its program with WTI prices below $45. This is crucial because many shale players need higher prices, $55 WTI prices, but not Devon. In Q3 2025, we had $1.7 billion in operating cash flow, $820 million in free cash flow. That's brutally solid. Additionally, there was an increase of 20,000 barrels oil equivalent per day through production optimization, plus a sustainable free cash flow boost of $150 million. And that's no coincidence, that's operational excellence. Now let's look at the last 12 months. We have revenue of $16.6 billion, EBITDA of $7.7 billion, net income of $2.7 billion, and operating cash flow of $6.8 billion. The balance sheet shows total debt of $8.6 billion, total equity of $15.3 billion, and net debt to EBITDA of 0.9. This is not a highly leveraged shale gambler. This is solidly financed. Liquidity. Currently, we have $4.3 billion available. D1 is not dependent on the capital market. Now let's move on to the dividend yield. This is currently at 2.2%. But importantly, Devon has paid dividends for 33 consecutive years. And that is commitment. However, in 2022, the yield was still at 10%. Today, it's significantly lower. Why is that? Because, among other things, oil prices have fallen, the share price has risen sharply, and we have a variable dividend structure that has been adjusted accordingly. And Devon combines the following: the base dividend, share buybacks, and flexible capital allocations. Q3 2025, $151 million in dividends and $250 million in buybacks. That's real capital, return to shareholders. But Devon is not a high-yield stock, but rather a cyclical upstream company. Now let's move on to a major lever, namely the Coterra merger. It was announced in the second quarter of 2026. All-stock merger with Coterra. Combined enterprise value, $58 billion. Synergies of $1 billion annually by 2027. And Devon shareholders will hold 54% of the new company. The planned new dividend after closing is approximately currently 32 cents per quarter. Additionally, there are plans for $5 billion in buyback programs on top. UBS estimates a plus of 9% free cash flow by 2027. This is strategically sensible because we have greater economies of scale and a better cost structure, and more free cash flow per share. But the integration costs are real. Now let's move on to the valuation and its key figures. Is Devon inexpensive? Currently, we have an EV over EBITDA of 4.4 and a price to sales ratio of 1.6. According to the analysis, the fair value is $57.6, which would be a 32% upside, but EPS revisions have been lowered. The market is anticipating an oil surplus. In 2026, there is a cyclical risk. So it's inexpensive, but not without risk. So what are the risks here? Oil price falls below $45. Integration risks with Coterra and analysts are lowering EPS. Plus, the stock is technically close to its 52-week high. And importantly, the dividend yield is not an 8 to 10% play. Anyone looking for high yield should definitely choose a different stock here. Now let's move on to the bullish case. Here, we would have a 10.4% free cash flow yield, a 0.9% net debt to EBITDA ratio, and $1 billion in synergies, plus production optimization and a reduction in Capex by $400 million. Financing would be possible even below $45 WTI, and this is a disciplined operator. Now let's move on to the conclusion. Energy is neither a dividend anchor nor a buy and forget stock, but rather a swift cash flow generator with a strong balance sheet and free cash flow. A machine and synergy lever thanks to Coterra. Attractive with WTI between $60 and $80, just like almost every upstream stock, but caution is advised in case of macroeconomic slowdowns or oversupply in 2026. For hard asset strategies, yes, as a swift building block, but not as the sole dividend anchor. You know, my thesis is between $30 and $50. With oil, I would definitely increase such stocks in general. I also have Coterra shares here. That means I will be rewarded on top here anyway, so to speak. Well, that's it for the video. This video is not investment advice, but simply my personal strategy. If you enjoyed the video, I would appreciate a like here. If you're not a subscriber yet, I'd be happy if you subscribed at this point. Otherwise, feel free to share this video if you found it valuable. Feel free to comment on which stocks you hold in your portfolio and what you think of Devon, or in general about Devon and Coterra since they are now merging. I'd really like to hear your opinions on that. I wish you all successful investing and see you in the next video.